Hello, my name is Nicole, and this video is about the synthetic short call strategy. Understanding synthetic options relationships can prevent you from accidentally tying up unnecessary capital in your trades. Today we're looking at the synthetic short call, and we're going to see if this strategy is worth the hassle. So what is a synthetic short call? A synthetic short call position is created by combining two positions: short stock by borrowing and selling shares, and a short put by selling a put. When you combine these two positions at the same strike price and expiration, you've essentially replicated the risk-reward profile of a short call option. Let's demonstrate what we just discussed in QQQ. I have the NASDAQ 100 ETF populated in the charts, and you can see here that that ETF has been on an absolute tear over the course of the last few months. And for the purposes of this demonstration, we're going to assume that I am neutral to bearish on the index. Let's head over to the trade tab here, and I'm going to select the September 19th, 2025 expiration. Those options have 57 days left until they expire. So opening up the option chain here, I am then going to short 100 shares of QQQ at the current market price. And I'm going to short a put against those shares to complete the short synthetic call position. And I'm going to go at the money. I'm going to short the 564 strike so that I can maximize extrinsic value in the trade. And when I populate that trade, we can see that the trade has a negative delta of 52, a positive theta of 11, a max profit of around 1380, and a buying power effect of $27,000 in debit. Heading to the profit and loss diagram, we can see that the trade makes money as the price of QQQ decreases, and the profit is maxed out at around $1,380-ish. We can see here that the trade would lose money in an unlimited fashion if QQQ were to continue to appreciate in price. So that is what the P&L diagram looks like for that trade. Let's head back to the table view here, where we're going to compare this to a short call option. So in order to replicate this trade, we need to sell a call option that's going to replicate negative 52 delta. And lo and behold, we would be selling the 564 strike call to replicate that trade, which is the same strike for which we sold the put. This gives us negative 52 delta, a positive theta of about 15, a max profit of roughly $1,765, and the buying power effect is quite a bit less. Our account would be debited by a little over $11,000. And when we bring up the P&L graph for this trade, we can see that it is nearly identical to the synthetic short call trade. So our profits are limited to about $1,707, and our losses are limited as the price of QQQ appreciates on the graph. So nearly identical risk-reward profile there. But the buying power effect is a fraction of what it would be with the synthetic short call strategy. Now let's do this again and just select some different strike prices to see how this would work for options that are out of the money. So I'm short 100 shares at the current market price. And let's say that I want to sell the 555 strike put where I can collect $1,000 to do so because I'm a little more bearish. And the net delta on this trade is negative 62, a theta of 12. The max profit is a little higher at $2,000. And the buying power effect is $27,249. And that would be a debit for our margin account. And when we look at the profit and loss diagram, it's very similar to the previous example. Our net profit would be a little higher at close to $2,000. And the max loss is unlimited as the price of QQQ appreciates. So very similar profile, but the numbers are a little different just because we selected different strikes. How would we replicate this with a short call? So we need to replicate this by taking a look at the delta, and we're looking for roughly 61 delta. And just like the previous example, that points us to a strike price that's the same as the strike price we used for the short put. And when we sell a call at that same strike price, the 555 strike price, we can see that we get a negative delta of 60, a positive theta of 15, Max profit of $2,300 and a buying power effect that's quite a bit less at $11,308. And the profit and loss diagram looks nearly identical. So here's why all of this matters for your trading. Let's say you're already short a stock and you're thinking about selling a put against it for extra premium. Before you do that, ask yourself, am I just creating a synthetic short call? If so, would it be more capital efficient to simply close my short stock and sell a call instead? The synthetic short call ties up a lot more capital than just selling the naked call alone. Your buying power goes much further with the direct approach, and you achieve the same risk-reward profile. So here are my final thoughts and key takeaways. By combining a short stock position with a short put position at the same strike price and expiration, a synthetic short call represents the exact same risk-reward profile as selling a call option. The goal isn't necessarily to trade all synthetics, but to understand them. This knowledge helps you recognize when you're accidentally creating complex positions when simpler, more capital-efficient alternatives exist. If this video helped expand your options knowledge, hit the like button and subscribe for more trading education. Drop a comment below. Have you ever accidentally created a synthetic position without realizing it? I'd love to hear about it. As always, thanks for listening and be awesome.